Mike, welcome. Good to see you.
Tyler.
Your work is turning up stocks that trade at less than 8 times 22-23 earnings. These are multiples we just haven't seen, and some multiples are down 3-4 times earnings. We just haven't seen those in well over a decade.
Look, it's an indication of the deep skepticism about earnings, and we all know what's wrong, right? We all know that the Fed's probably going to over tighten. They're probably going to tighten until something breaks. Jamie Dimon is saying we've never seen this before. You were just saying we don't know what's going to happen here. So we started seeing this. We took a look actually at it, and there's 12.5%, I think, of the Russell 3000 trades at less than 8 times 2023 earnings. That's up about threefold from a year ago. So right, from 4% of the total to 12% of the total. So there's, again, it's just an example of the deep skepticism that's going on. All I know is that given how difficult this environment is to understand and predict, and some of the uniqueness of it, the fact that we've never seen it before, I kind of want, at least for some of my portfolio, a call option on the Fed being right. Right? I think that's not happening. We don't see a whole lot of that. And I think some of these ideas give you that.
Mike, it's interesting to hear you say, we know they're going to over tighten it. And I mean, I still remain concerned that they're going to under tighten. And that the much bigger risk is that inflation is around with us for a lot longer than people expect. I mean, I know it's a lot that they're doing right now, but not if you look at nominal GDP, not if you look at what's going on in the labor market and the fact that they're way below anything resembling neutral and hesitating to even do more than a couple of half-point rate hikes in the next couple of meetings this year.
Yeah, it depends on what you mean by not tightening enough, right? I mean, here's the challenge. They could tighten enough so that we could see the economy roll over, but inflation remain. And that's the worst part, right? You get a recession, either economically or an earnings recession that really takes the legs out of the stock market, yet inflation continues. That's, of course, the biggest worry. And so I think the Fed's credibility is at stake. I think they're going to do their best to take care of the inflation that they can take care of, which is mostly driven by productivity and by labor. They can't do anything about the price of oil, for example.
So out of that 12% of the 3,000 that are trading at that low multiple, you have landed on 3: Nexstar Media Group, Williams-Sonoma, and Jefferies Financial. Why? Yeah. What is it about those 3 that makes you more sanguine about them than some others?
Yeah, well, the first thing is we look at companies from a multitude of angles: valuation, growth rates, capital use. We love people who really understand how to treat shareholders well, and we think all 3 of these companies do that. Williams-Sonoma has turned itself in from being a mall store company to being this omni-channel real dynamo, and they've done a wonderful job. They're trading at 4.2 times EV to EBITDA at the moment, right? Okay, so we understand the furniture business is going to slow down next year if the economy rolls over and housing is weak. Great, good. Does that mean you trade at 4 times EV? Right? I mean, that's the question. And so these things seem to be really, really deeply depressed. Nexstar is a great example. These are your local TV stations. These are your eye in the sky, news, weather 5, right? These are your ABC, NBC, and CBS affiliates with Fox all over the country. They live on advertising. We know the advertising market's going to be weak, but these are really good, smart capital allocators. They're raising their dividends. They're buying shares back. They're trading at 7 or 8 times earnings. And by the way, we have an election coming up in 2024. So they're actually trading at about 5 times earnings if you estimate out to 2024. So again, a really neat opportunity to buy something pretty cheap. And if the bottom doesn't simply fall out, you could easily get a double here. And our last one is Jefferies. Again, a wonderful investment bank, taking market share from some of the biggest players, really inexpensive. And yeah, we all know that deals are slowing down, but we think they're going to be able to make up for it. And the fact that you're paying, incredibly low multiples for these kind of names is again, to me, it's a call. It's a deep out of the money call option on the Fed being right. That is not bringing the economy down to its knees and not bringing earnings recession about. So that's really the story. And I think believe me, guys, you will never find these in Cathie Wood's portfolios, right? These are the antithesis.
You can say that again.